What's up, world? It's your boy Ross Mac of Maconomics, and yeah, let's talk about it. Now, investing in the stock market is always a risk, which is why it's important to do your research on a number of factors that might impact a company's stock. Now, one piece of information that day traders pay close attention to is float, which is the number of shares available for the public to actually trade. Now, stock float is an important metric because it gives investors a sense of the liquidity of a company's stock. One thing to know, not all shares of a company are available to the public to trade. Some are saved specifically for owners, investors, and current and future employees. Now, you could calculate a company's floating stock by taking the total number of shares and subtracting it from any closely held or restricted shares. Now, low float stocks have a small amount of shares the public can trade, usually between 10 to 20 million, but sometimes as low as 1 million. Now, to put that in perspective, larger companies have floats somewhere in the billions. Generally, a stock's float is looked at as a percentage. Here's an example. If a company has 500 million shares and 450 million float shares, it will be considered a high float because 90% of the shares are available for the public to trade. On the other hand, if a company has 20 million shares and only 4 million are available, it would be considered low float because only 20% of the shares are available. Now look, a stock's float shouldn't matter as long as you're a long-term investor, but day traders often look at stock's float as one of the key factors in deciding if they want to trade. Now, there are always risks with every investment, but low flow stocks can present specific challenges. The volatility with low flow stock means investors can make large profits quick, but also means it can be wiped away really fast. So look, if high risks aren't your cup of tea, you could consider other metrics and strategies to guide your investment decisions. Regardless, be sure not to rely on a single measurement to make investments. It's usually just one piece of a much larger puzzle.